Welcome back for your financial news update. I am your host, Kyle. Today's date is August 2nd, 2024. Friday is finally here. I was hoping markets would be a little bit more calm and relaxed, but that was evidently not the case at all. We had some more economic data come out this morning. Bright and early, we got unemployment came in at 4.3%. Now, previous readings, 4.1%, and prior to that, 4.0, 3.9, 3.8, et cetera, et cetera. Pretty slow growth in terms of rising unemployment. But now we have gone from 4.1 to 4.3. And I know these percentages are still small. We're talking about fractions of percentage points. But the potential problem here, and this is something that I've highlighted in another video recently, a potential problem is that we're looking at what might be acceleration of the growth in unemployment. And that is some possible room for concern. Now, potentially later on, these numbers get revised and edited to either be lower or higher than they are. I do also find it a little bit interesting that for the last 3 months, 4 or 5 months, the last 5 months, consistently the forecasts for expected unemployment numbers are lagging behind the actual reportings. And I know that's certainly not an exact science, but when we're showing consistent growth in the unemployment numbers to begin with, I don't see why forecasted unemployment numbers wouldn't also be accelerating with that, almost as if it's trying to intentionally formulate a bad reading. Markets did not react well to it at all. Indexes took a heavy sell-off today. It was already not looking great after market close yesterday, and we have now just exacerbated that even more so. The S&P 500 is down 1.7%. The NASDAQ is down 2.5%. The Dow Jones is down 1.5%. So across the board, we're seeing pretty significant selling, mainly, of course, from the technology sector, which is driving a lot of our economy these days. And just yesterday we had Intel announcing their layoffs in the thousands, north of 10,000. And I think the other tech companies at the moment are doing okay in terms of layoffs. Hopefully there is not more layoff rounds to come. So long story short though, this could be some of the economic data that we're waiting for to really put the Fed in a position to where they feel like now is the time to lower interest rates. So it's entirely possible that in the September meeting coming up a month and a half from now, which we will have much more data in between now and then, and possibly even we will have counter narrative data than what we've currently had. Possibly the next unemployment reading at the end of August will come in at 4.2% or 4.1%, and possibly that data will be revised. So I'm trying to hang on to a bullish narrative for as long as I can. I mean, in a market that has been rallying as strong as what we have had for the last 12 months, the past trailing 12 months, right? The S&P 500, even though it's down 6.5% from all-time highs currently, it's still up 29% in the past 12 months. So it is an uncomfortable dip and sell-off, but we are still leaps and bounds above, your averaged annual return. Markets are still doing great. The economy is still growing. I'm still not ready to flip my script and go all bear. Like I also mentioned yesterday, we could very well experience a negative 10%, if not a little bit more, swing and rally right back on up towards all-time highs. So we will just need to be patient here. Some companies are getting beat up more than others, but that's just the way it goes. I am not bullish at all on cryptocurrencies. I think larger institutions are wanting to get in way lower than current prices, and we are seeing Bitcoin having already dipped down to 53,000 or so and then rallied back up to 70,000, which was impressive in itself. Everybody thought that that was going to be, this was the move that we're seeing today in charts, that this was going to be on the road up, breaking out towards 80, 90, and 100,000. And I think kind of across the board, we're seeing this rug pull happening. New accounts and people thinking that markets only go up and it's just so easy to make money are in for a little bit of a attitude adjustment. So it's not uncommon to have these sharp sell-offs on the way up. In fact, it's pretty natural. And just like on the way down, it's not uncommon to have sharp, explosive buying reversals back towards the upside before it continues back down. And we saw exactly that on, Wednesday. Markets were rallying super hard after having already sold off some 5% or so, some 4.8%. And then we rallied super hard on Wednesday before the FOMC ever even took place, before we had real justification for doing so. And then post FOMC, even though that in itself wasn't necessarily bearish or bullish, it was just pretty neutral. It was what market participants were expecting. I don't think it was a surprise to anybody that we didn't change interest rates. But look at how much we have sold off in the following 48 hours. Almost 5%. I'm measuring it at about 4.95, 4.92%. That's a pretty decent sized move for that short of time frame. So you get those sharp swings up and then it sweeps right back down, makes new lows, and eventually here we should bottom and then determine from there based on kind of economic data and where the Fed is looking and what they're deciding to do if we continue back upwards. I think once we start actually getting interest rates, that is going to inevitably lead to a rally, just simply because yes, it's showing that there is weakness in the economy. At the same time, though, it opens up stimulation for the economy. So in an economy that's still growing, where unemployment is granted rising, but it's not necessarily high. We're not talking about 6, 7, 8, 10% plus unemployment. In fact, if you look at the averaged unemployment, where it typically has been over time, it averages out to about 5.5 to 6% unemployment. So we're not even up towards the average. And same with interest rates. If you look at interest rates averaged over time, we're right about where you would typically expect them to be, about 5.5 to 6%, maybe a little bit more than that. So even though it is higher than what they were on all accounts, I think people maybe just became a little bit too accustomed to it, and simply us normalizing is causing people to be uncomfortable because it's just a new state to them. But it is surely not normal for markets to be going, from where they were even in April of just a couple months ago, from 4,900 all the way up to 5,600 on the S&P 500 index. And if you go as far back as October of last year, we were down to 4,100, and we rose all the way up to 5,600, almost 5,700. I mean, we're talking big moves. So it's okay to shave a little bit off the top. It should not be panic. It should not be reason for panic, at least. And I'm certainly not even beginning to get uncomfortable at this stage. Though I am trying to just kind of, like Jerome Powell, choose my words a little bit carefully, because I'm not trying to incite one belief or narrative over the other, right? In markets, we're going to have bullish action and we're going to have bearish action. And sure, maybe we get more bullish days than we do bearish days. And so there is a tendency to lean a little bit more positive focused. And naturally, we want to see markets grow and all that jazz too. But yeah, down days are just a part of the program. That's just the name of the game. So we'll just continue to be patient. I am starting to, now that we're approaching the -7% territory, I am starting to explore maybe some particular tickers that I might want to invest in, given the opportunity is right. But personally, for me, we'd have to decline even a little bit more than we have so far before I jump on that. So it's hands off for now. The weekend is here. Enjoy your weekend. Get some sun. Don't worry about the markets. We will come back Monday and check back in on them. Don't worry about the economic data. Yes, unemployment is ticking up a little bit faster than expected, but it's still not at a dangerous level. We're not talking like Great Depression or severe recession or anything like that. And until the next Federal Reserve meeting, we'll just have to continue to break down economic data as we get it. Maybe it won't be as bad as this. Who knows what plays into why unemployment is ticking up any higher right now than it was in previous readings. So thank you so much for watching. Please consider liking and subscribing. Your support means so much to me. I hope you all have a great weekend. Enjoy some sun. Enjoy time with family and whatnot. Don't worry about markets. I will check in with you all on Monday.